Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we were working on the theory videos for Chapter 7, which is for cash and accounts receivable. And in this video, which is the fifth in the series, we are going to be talking about the, let me find the slide. There we go. We're going to be talking about the percentage of sales method. So just as a quick recap, let me get my pen here. What we're looking at here is, we're, from an accounting perspective, if you think about the way the book was, or the way you're being taught, all right, chapters 1 through 3 basically gave you the basics of, how the information flows through the books, and it was also basically about how to keep the books, so your bookkeeping. And then, chapter 4 and onwards is now going to start going more and more in depth into various aspects of the accounts and methods and things like that. So here in chapter 7, we're talking about cash and accounts receivable. How do you keep track of your cash and what we do with accounts receivable. So when it comes to accounts receivable, yes, remember you have the general ledger account itself, and then you have your subsidiary ledger, right? And when you look at your general ledger account, whatever balance you have in that general ledger account, let's say it's 10,000, well, in your subsidiary ledger, all of your customers, right, whatever their balances are, they should also balance to be the same amount as what you have in your general ledger account. So your subsidiary should match your general ledger account. And so whenever you have a journal entry and you affect accounts receivable, remember I had said you have to put it in two places. You put it to the general ledger account, and you also have to make the same entry into the subsidiary ledger account so that the two can balance. So when you get to the end of the accounting period, and you run a pre-adjusted trial balance, okay, what you're doing with that trial balance is you want to make sure that the balances in the accounts are correct. Well, what we're going to do is you're going to look at, your accounts receivable account, and you're going to say, okay, is the balance in my general ledger account the same as my subsidiary? And if it isn't, obviously you have to make a correcting entry in order, because you made a mistake somewhere, in order to fix that. But that's not the end all be all of accounts receivable. Okay, realize that with your accounts receivable, you have bad debt. I mean, you're extending credit, and you're not always going to get everyone to pay off their debt. Okay, you're going to have a certain amount of bad debt. So your accounts receivable, whatever that balance is, in this case here, say it's $10,000, that 10,000 is not good, all right? A portion of that, whatever that portion is going to be bad debt. So you can't look at the accounts receivable and say, yes, that's what, people owe me. No, if that bad debt portion is, say, $2,000, okay, well, your accounts receivable is not 10,000. Your accounts receivable is the difference between the two, 10,000 less your 2,000, or your actual accounts receivable is 8,000. Okay, but when you look at that general ledger account, you're only seeing the 10,000. So you have to, make an allowance for that, and that's why we use the allowance for uncollectible account or the allowance for doubtful account. Same account, different name. That's all. It just depends upon the business. I mean, I learned by using doubtful account. This textbook uses uncollectible account. But the point being here is that you have to account for that bad debt, and you account for that bad debt in one of two ways. You account for it using either the direct write-off method, or you use the allowance method. Okay. Now, if you have your accounts receivable and say you only have 30 customers, right? Well, it's easy to keep track of those 30 customers so that if you see, Betty Smith Inc. owes you, say, $350 and it's been, a year and a half and you still haven't been able to collect it, well, that's bad debt. That's part of that quote unquote $2,000. That's bad debt. So because you're able to identify that readily and easily because you have so few customers, you're going to write it off directly. In other words, you're going to just take it right out of accounts receivable and put it to your bad debt expense. And this was covered in bad debt. And this was covered in a previous video. But when you have a lot of customers, all right, let's say you have 1,500, 2,000 customers, it's hard to keep track of each and every individual client. Or think about credit card companies; they got tens of thousands of customers. They can't look at each and every individual one. It's just not efficient, and it's just too costly. So what they end up doing is they end up using the allowance method. And the allowance method, basically, what you're doing is you're going to make an estimate, okay? And to make the estimate, there's two different methods to make that estimate. The first estimate is the percent of sales method, and the second one is the aging method. Okay? So in this video, we're going to look at the percent of sales method, but realize that whichever one you choose, that's the one that's going to determine how much bad debt you're going to write off using the allowance method. So these two methods are a subset of the allowance method. Right? So now let's start looking more at the percent of sales method, which is the focus of this video. Okay, so I'm going to set up T accounts just to make things a little bit easier here. And I'm going to just call this allowance. All right, allowance. And this is actually should be titled allowance for uncollectible accounts or allowance for doubtful accounts. I'm not going to write it all out. And I have bad debt expense. Okay, so let's say my accounts receivable is $10,000, right? And let's just say that I'm using a calendar year as my accounting period. So we go from January 1st all the way to December 31st. And now it's December 31st and it's the end of the year. So we're going to close out the accounting period. It doesn't matter whether it's yearly, monthly, at the end of each and every accounting period, what you run a pre-adjusted trial balance. You should be familiar with this from chapters 1, 2, and 3. You run a pre-adjusted trial balance, which is nothing more than a listing of the ledger accounts and the balances in those accounts, right? And what you're doing is you're going, as part of the closing process, you're going to run the pre-adjusted trial balance, and then you're going to look at each and every individual general ledger account to determine how, if it's the correct balance in the account. So obviously when we come down and we see the accounts receivable account, and it's at 10,000, well, we know that that's not an accurate number because part of that 10,000 there's going to be some bad debt, okay? So we have to figure out how much of that is bad debt and make an adjusting journal entry for it. Okay, so let's say also that in our allowance for doubtful account, we had previously $1,000 of uncollectible accounts. So to just give you a general idea what we're talking about here is on the balance sheet, as you look at your accounts, you're going to have your cash account, and then you'll have your accounts receivable, and it'll be 10,000 here, and then you'll have less your allowance for doubtful account, right? Which is going to be, in this case here, $1,000 because that's what's in our allowance account, and then you'll have your net accounts receivable, which would be $9,000. And then after the accounts receivable, you might have, computer, equipment, whatever. All right. But that's what your balance sheet will look like. The important part here is that now we're able to say, okay, my accounts receivable really is 9,000. My books show 10,000, but I know 1,000 is bad debt. Okay. And the net is the 9,000. That's the true value of my accounts receivable. Right? So that's what it looks like on the balance sheet. Now, the whole idea here behind, we have to look at this 10,000 and say, okay, how much of that is going to be bad debt? And we're going to use the percent of sales method. So let's say let's say we have $300,000 in sales revenue. Okay, so our sales revenue account, our general ledger, sales revenue account, or revenue, whatever the name is, sales or sales revenue, it has a balance of $300,000 in it. All right. We know that from a historical perspective, meaning, when we look back on our books, when we look back at our books, we determine that as a percentage of our sales, 0.5% of it is always bad debt. That's historical for us. We're going to look back at the, a previous time frame. And generally, it's going to be about 3 to 5 years. So from, we're going to look at the past previous 5 years. Now, if you're a new business, you don't have a number to go by. So you kind of like do a little bit of research, and you see what the industry standard percentage is. Maybe the industry standard is, let's say, 1%. Okay, well then you would use 1%. But as you go from year to year, especially when you hit like year 2, year 3, now you have to look back at your own books, and you're going to know what percentage is bad debt. All right, because you're going to be able to see what that bad debt expense was, and you're also going to know what your sales were, okay? And you're going to be able to figure out whatever percentage that is. And if your percentage is 0.5%, then you use the 0.5%. If it's 1%, then you keep using the 1%. If it's 1.5%, then you use the 1.5%. So you're looking back at your records for like last 3 to 5 years, and each year you have to you have to take a look at that percentage again and again and again, in order to determine what that percentage is. Now, it's not going to change that much. And let's say you decide that it's 0.5% this year, and then the next year it's actually 0.55%. Well, you don't have to go changing to 0.55%. You could still use the 0.5%. But if for some reason in your rolling number it jumps up to 1%, then you should end up using the 1% and not the 0.5%. Okay? All right, so with that said, we've looked back on our books and we've determined that, excuse me, that our percentage of bad debt, our percentage of sales that is bad debt, is 0.5%. When I look at, remember this is 12/31, when I'm looking at my revenue account here and I see there's $300,000 in it, I take 0.5% of that 300,000, right? And that would give me like $1,500, right? That's the amount that I'm going to use to make my journal entry, right? And remember, my journal entry is going to be a debit to bad debt expense for $1,500 and a credit to my allowance for uncollectible or doubtful account for $1,500. So when I make that journal entry and I post it to my ledger accounts, I'm going to have $1,500 in my bad debt, and I'm going to have $1,500 in my allowance account. Okay, so that's the adjusting journal entry that I'm going to make, right, to my books. All right, so Now when I post that adjusting journal entry to my ledger accounts like I did here, I have I have new balances in my account. So now I create and adjust a trial balance to finish out the closing of my accounting period. I create the adjusted trial balance, then I create my financial statements, and then I make my closing entries. Now, when I create my financial statements, remember my accounts receivable is going to have my 10,000. I'm going to have my less my allowance, which will be the $2,500 in this case. And so my net accounts receivable is going to be $7,500. All right. My books show 10,000. I know that I have $2,500 in bad debt, and my net realizable accounts receivable is $7,500. Now, you've created your financial statements, and obviously you have to make your closing entries, right? So when you make your closing entries, what are you doing? You're moving the balances from your revenue and your expense accounts over to your retained earnings account. So as part of the closing entries, I'm going to make a credit to bad debt expense for $1,500 so that the balance in my bad debt expense account is going to be zero. And remember, that amount goes over to retained earnings. Okay, so on my books, when I'm looking at my post-closing trial balance, I'll have $10,000 in my accounts receivable, I'll have $2,500 in my allowance account, and of course my bad debt expense account. All of your expenses will have zero balances. And now you're ready to start the next accounting period. Now, notice something here. Notice that based upon this 10,000, all right, that my allowance account keeps on going up, right? If the next year, let's say I had so we've gone, like, let's call this 2015, and now next year we're at 2016, and let's say my accounts receivable is 15,000, right? Because let's say it went up 15,000, so now I've got 25,000 in my accounts receivable. Well, I'm going to do the same thing. I'm going to look at my sales, okay, and I'm going to say, okay, let's say I had, and let's use the same amount without having to do a lot of the calculation. We had 300,000 more in revenue at 0.5%. So that means I'm going to have to make this journal entry for $1,500 again as an adjusting journal entry. And when I do, right, when I do, I have the $1,500 in bad debt, and I'm going to add $1,500 more to my allowance account. Right, so now I'm at 4,000. Well, if you notice that if all we're concentrating on is the adjustment for the allowance for uncollectible account, that allowance account is just going to keep going up and up and up. It started out at 1,000, I added 1,500, I added another 1,500, it keeps on going up. But that's not how it actually works. Remember, during the course of the year, you're going, part of, your accounts receivable, you're going to say, okay, Betty Smith, Inc. owed me $1,000, okay? And you're going to say, that is no longer, I know I'm not going to be able to collect that $1,000 anymore. So let me back up just one second here. She owes me $1,000 and I know I'm not going to be able to collect that anymore. Well, you're going to have to write off her accounts receivable, right? Because you don't want it on her, part of this here, 10,000, is this $1,000 that's bad. You don't want that on your accounts receivable. So you're going to have to make a journal entry where you're going to credit your accounts receivable for and that would be the Betty Smith Inc., right, for $1,000. And you're going to debit your allowance for doubtful account for $1,000, right? So when you post this journal entry, right, when you post this journal entry, you'll have a credit to accounts receivable for 1,000, and you'll have a debit to your allowance account for $1,000, right? So now your allowance account is not 2,500, it's only 1,500, right? Because you have 2,500 in credit and 1,000 in debit, so your allowance is only 1,500 is going to be the balance in that account, and your balance in your accounts receivable is going to be $9,000. Okay, so during the course of the year, you know, whenever you determine an accounts receivable is bad, you have to write it off and make that journal entry to write it off. And when you do, it's going to affect your allowance account. You don't write it off to bad debt. That's the direct write-off method. It's not the allowance method. Okay. We only make an entry to the bad debt expense when we do the calculation to determine what our estimate for bad debt is going to be. Okay. And by doing that, we actually expense, and we use what's called the matching principle, where we want to expense to match our revenues, and that's why we make that journal entry. But you know, that still leaves our accounts receivable hanging, and when we determine that the accounts receivable is bad, we make the, you know, this journal entry so that we can adjust our accounts receivable to its true accuracy, which then also affects our allowance account. And then when we come to the end of the accounting period and we do the calculation again, okay, now when we make that journal entry, now we're going to make that adjusting journal entry for 1,500, and okay, I'll just write it here. I'm not going to erase it. So that would be our $1,500 adjusting journal entry, right? And now the balance in our allowance account is $3,000 and not $4,000. So that's how that's how the allowance account keeps from going up and up and up and up and up. Because remember, even though every time you make that adjusting entry, you know, to estimate your uncollectible accounts, that's going to make the balance go up. But it should be offset by the actual accounts receivable that you do decide to write off. Remember, you're using the percent of sales method here, okay? So you're kind of like saying, okay, you know, what is my percentage of that sales? That is going to be bad, all right? And you know that as a hard figure, okay? And if your allowance starts going up and up and up and up and up, and you're not writing off your accounts receivable, well, your accounts receivable is out of whack. And then you have to go through the accounts receivable and say, okay, you know, which accounts are bad, you know, definitely bad. I mean, I haven't collected them in 3 years. Okay, well, they don't belong on your books. And then you have to make that entry in order to bring your accounts receivable down, which will also bring your allowance down, the allowance balance down. Okay, so I hope that made sense. You know, I know the screen looks a little bit messy, but I'll just try to quickly recap it here, since I'm already at a pretty, you know, I'm already at like 23, 24 minutes here. I'll just give a brief recap here. So, you get to the end of the accounting period, right? You determine what your percent is. In this case, we determined 0.5%. You determine what percentage of your sales is going to be bad. So then you look at your sales revenue account and you see the balance in the sales revenue account, and you take and apply that percentage. That's the amount that you're going to use for your adjustment, right? When you make that adjustment, now your allowance account becomes, it was $1,000, now it's $2,500. That's reflected on your balance sheet because you have your accounts receivable of 10K less your allowance of 2,500 to to give you a net accounts receivable of $7,500. Okay, so that reflects your true accounts receivable. So you make that adjustment, you create your financial statements, and then you create your closing entries. And when you create your closing entries, your bad debt, right, you're going to offset your bad debt, so the balance in your bad debt account is going to end up being zero. Okay, but the balance is still, you have the 10,000 in the accounts receivable, and you still have the $2,500 in your allowance account. But now notice that if I just keep on making that entry, all right, my allowance account will just keep on going up and up and up. Why? Because I'm not offsetting it for what is actually bad on my accounts receivable. So if I have, I determine that, oh, that Betty Smith Inc. is actually a bad debt, okay, then I have to make that journal entry, all right, to offset my accounts receivable. All right, and when I do, I'm making that journal entry to the accounts receivable and to the allowance account. Okay, so now the balance in my allowance account is $1,500, and this is how we keep it down, because remember, the percentage we're using is based upon the sales. Okay, we're saying, okay, we know this to be, based upon our empirical data, we know that this percentage of the sales is actually bad, and we're writing that amount off. And over the period of time, we're looking at these accounts and saying, okay, this accounts receivable for $1,000 doesn't belong on our books, which now makes our accounts receivable $9,000, okay, and brings our allowance down, right? So this is how we keep the allowance down, because truly this $2,500 is really bad. It's just a matter of when we're going to decide to write it off. If we decide to write off everything all at once, well, then our allowance account would end up being zero, and our accounts receivable would have ended up being $7,500, because we wrote off everything all at one time. Okay, but generally you don't do that all at one time, because it's you don't just today say, okay, something is bad. I mean, 90 days, you don't say, oh, this is a bad account. You might give it some leeway. It could be 6 months before you actually decide that it's time to write it off. But your accounts really shouldn't go more than 1 year as being bad. They should be, written off. So I would go back through at the end of the accounting period, and I'd say, okay, which ones have hit the 1 year mark? Well, they have to actually be written off, and then I'd make this adjustment for the 1,000 to write off, any account or each account that is truly bad, in order to keep my allowance down. And then at the end of the next accounting period, we're going to make, we're going to do the calculation again, and if we had 300,000 more in revenue at 0.5%, that's an additional 1,500. So then we'd go and we make the adjustment to the bad debt, and we continue from there. Okay, so I hope that was understandable. If you didn't get it, I mean, it's not covered. I mean, you're shown the calculations in the textbook, but you need to understand where you're at in the process, okay, and where the numbers are coming from and how they affect the different accounts. So go back and watch this video again if you're not getting it fully. Everything is covered here. Work through some numbers for yourself, and if you still don't understand something, feel free to telephone and speak with an instructor. Okay, so that's the percentage of sales method. And in the next one, we're going to look at the aging method, which is slightly different. Okay, well, I'll see you then.